Once again, thank you for joining me, Greg Reese, authorized certified trustee for the Deferred Sales Trust, talking today on the topic of building the bridge with clients or CPA or professional attorney. The disclaimer, everybody knows we're not here to give legal or tax advice today. I'm hoping that there will be some CPAs and tax advisors on the call that are looking to learn a little bit more about this, whether their client had introduced it to them, the other way around, or they're just looking to get some more information on a new tool and a new strategy that could be added to their quiver of services they offer their clients. So today, really, what we want to talk about is creating open collaboration with our clients and prospective clients, professional advisors, their CPAs and their attorneys. The potential stumbling block that can occur is that CPAs and attorneys do not trust what they're not familiar with. The term deferred sales trust is a trademark term, and that term may be new to them. So as most of us on the call know, the DST is not new, but it is still new to a lot of people. And the reason for that is it's a proprietary strategy that is not being utilized by tens of thousands of tax attorneys around the country at this point in time. And so it doesn't have the same level of traction as, say, an awareness as, say, a 1031 exchange. But it's been around for over 2 decades. It's passed, all the hurdles associated with considering a particular strategy to be legal, proven, and tested. And we're going to talk a little bit more about that today. But what we hope to kind of accomplish and help you with some tools when you're talking to maybe your client's advisors is to let them know a little bit about the DST, when it may be suitable for a client to consider, that in fact we can demonstrate the DST's viability and track record. That's the first thing. Instead of having them dismiss it out of hand because they just haven't heard of this before, that there is a legal basis for it. There is a track record for it. So, and we can demonstrate that pretty effectively. So, the questions we would want to ask is, will you help your client vet the DST on that basis? And can we ask the client's advisors to do the same? So what is the DST? The DST is, essentially a specialized form of installment sale governed under IRC 453, as opposed to tax deferred exchanges, which is sort of an alternative, which is governed under IRC 1031. So let's define 453 for everybody. Section 453, paragraph B, defines an installment sale as a disposition of property for which at least one payment is to be received after the close of the taxable year of disposition. In doing so, the seller or taxpayer will only be required to report payments received in each taxable year. Installment sales have been around for 90 years, at least IRC 453 has been around on the books for 90 years plus, and it's used tens of thousands of times each year. And, it does precisely what the code section prescribes. There are rules governing this, obviously, and we adhere very closely and strictly to those rules and guidelines. But essentially, the idea is when you sell your asset, instead of taking all the proceeds up front, which means you have to recognize and pay taxes, then you can turn that into an installment, receive your proceeds plus interest over time, and only recognize and pay taxes as you actually receive payments from year to year. In the real estate industry, an installment sale is typically referred to as a seller carryback. Sometimes an AITD, or an all-inclusive deed of trust, where the existing mortgage is being paid, you're paying the seller, he's paying the mortgage. That's an installment sale. Business owners that are selling, oftentimes they're carrying some paper back on the sale. They're not receiving 100% of the proceeds. The buyer wants the seller maybe to stay on for a little bit to help make sure that the business is operating properly for the new buyer. They want to make sure that they're getting what they paid for, and we want the seller to have some continued skin in the game. So, typically we might refer to that situation as an earnout. So an earnout, when you're not receiving all the money up front, meaning that you're going to receive some portion of your sale in a future year, that's an installment sale, and it's governed under IRC 453. So having said that, let's take a look at, how installment sales are typically viewed in the marketplace, by sellers and tax professionals. Oftentimes, sellers and tax professionals will shy away or tend to shy away from traditional installment sales. The reason for that is that the seller will absorb extra risks when they decide to be the lender or carrying, some of the financing for the buyer. There's always the risk of non-payment. There's the risk that the seller will have to foreclose on the asset, if payments are not made on a timely basis. There could be damage or reduced value to the collateral. It could be due to market conditions. It could be because the buyer did not take as good of care of that asset, that business, or that property as you did. So when you go back and have to foreclose, you might find yourself with a bit of a mess to clean up, which could be costly. And it may not, carry the same value. And there's always the risk of renegotiation or early payoff. So sometimes sellers will enter into an installment arrangement with their buyer because they don't want to pay all the taxes in the year of sale. And they like the ability to spread them out, get their full value, but spread out the tax payments. But it's not uncommon that a buyer could want to renegotiate for terms that are, more amenable to them at the expense of the seller. They could go to a traditional lender or other financing source and refinance that debt or that carryback, pay you off. Now you got to pay all the taxes again. So, and typically, that can happen at the worst possible moment for the client. What the Deferred Sales Trust, does in one respect is it returns the control back into the seller's hands. So the risks associated with a traditional installment sale are such that many sellers don't want to, extend that kind of a benefit for too many years. Tax preparers are concerned about the risks as well that the sellers would engage, and so they would prefer to see the client be able to get all cash financing, if you will. Sorry about that. The phone's ringing in the background. And so they tend to, oftentimes shy away from that type of arrangement. So, but with the DST, we effectively can remove all of those risks or those disadvantages for the seller. The seller has the ability then to earn personal income on the money they otherwise would have paid in taxes. It does, as I just said, it helps enhance the advantages of doing an installment sale while eliminating all those key disadvantages. There are stringent seller protections involved with the DST to protect the seller's funds, to give the seller lots of control, lots of flexibility, and lots of options. It can also help a seller move from risk-prone, illiquid collateral to diversified investment-grade collateral. So think about this. If you engage in a direct seller carryback, your only collateral is the asset you used to own. So it's a single asset in a single asset class run by somebody else. You have no control over what happens. That adds risk to the seller. But with the DST, you can move away from that being your sole source of collateral for repayment and move it into any investment classes that you deem appropriate for your own objectives, whether it be diversified portfolio of marketable securities and related, or back into real estate, or maybe back into another business. There are, hundreds of potential options for the seller to diversify their proceeds. And the strategy is legal and proven and tested. So we'll talk about that in a second. What I like to do is start with a simple, sample case study. So this would be John Smith, sample case study. John is selling either a business or real estate, doesn't matter. Let's assume that the selling price is $5 million, that the basis of the business or property is $1 million. That means that they're facing a $4 million capital gain, which would be taxed. And I'm just using, California rates for the state income tax, but we can apply this to any state because the DST is based on federal law, of course, so that therefore it is available for a seller of an asset in any state. And it even works for people that live in states like Texas and Florida with no state income taxes, just depending on the amount of gain you're looking at. So in this particular example, with a $4 million gain, the taxes due on that, in my example, would be almost $1.5 million. So imagine if you and the client's tax advisor could help solve this problem. From a tax advisor standpoint, we believe that if they take the time to do the due diligence and really look at this, look at the history and the track record, that they would jump at the opportunity to have this strategy available to present to their clients, because, you know, there's two types of CPAs really, or tax preparers. There's the type that just do the processing of tax returns, just file returns and do the transactional side of things. And then, you know, but the vast majority are also tax consultants. You know, they have a responsibility and an obligation, and the clients have a desire for that tax advisor to help them save money on taxes. I mean, that's their primary function. File my returns correctly, of course, but what can you do to help shave off some taxes? Are there legitimate ways I can do that? And so having a tool like this is extremely powerful, and I think it can make tax advisors look like rock stars, to be honest. So let's look at, introducing the Deferred Sales Trust. Again, the overview, it's a specialized type of installment sale under IRC 453. We've got a long track record of success. The IRS has reviewed us multiple times. There's been 14 separate field audits, every one resulting in a no change letter over the last 2+ decades of successful transactions. During the last 2 decades, we've completed over 3,000 individual transactions, totaling about $100 billion with a B. We've had 2 in-depth formal IRS reviews that both resulted in absolutely no changes to the strategy whatsoever. The first one was completed in 2008, and the second one, as sort of a follow-up, was in April of 2019. The first one was conducted by a senior IRS officer in the Laguna Hills office, California, which deals with tax shelter reviews, et cetera, because they weren't quite sure the Deferred Sales Trust. Again, the term was unfamiliar at that time to the IRS too. So don't be surprised that a CPA or another independent practicing attorney might not have heard of it yet. So the IRS saw marketing, advertising, returns being filed, and they weren't quite sure exactly what the Deferred Sales Trust was. So that triggered them to politely ask for a review of the strategy, along with about 10 years worth of transaction records. So that was done over about a 5-day period in 2008. Sent it to DC after that review, and they closed the review with no changes, no adverse findings whatsoever. And then in 2019, as I mentioned, they did a follow-up review with the head of the IRS office in Los Angeles, California, and they had re-reviewed their notes and their records, and they just really wanted to make sure that there wasn't anything new that was being adopted within the strategy or how these transactions get handled that would cause the IRS to want to take a closer look. So they were satisfied, closed that review as well, no changes, no adverse findings. So the IRS is probably, that's the biggest entity you want to know if the IRS has looked at this. If there were audits, what were the results? Perfect. If there were IRS formal reviews, there have been, perfect. FINRA has also looked at this deeply because once a client will sell a business or a piece of property, they're going to redeploy and have their proceeds reinvested in some way, much of which is going to be reinvested in the financial markets, with the help and assistance of a professional investment advisor. So if that's the case, and an advisor is helping manage money for a particular type of a trust, FINRA wants to know everything about it before they will allow the investment advisors to participate and manage funds in that capacity. So FINRA took a deep dive, and effectively every investment advisor in the country is eligible to manage money for DST trusts. Besides that, what about the peers? What about the peers? There's a number of top national tax law firms and CPA firms that have done independent deep dives. They've signed NDAs with our tax firm that created the DST, which is Campbell Law, to satisfy themselves independently that this strategy is legal, proven, and vetted, and that it could be appropriate for some of their own clients. And so, so that's a pretty strong, pretty powerful and positive track record. And beyond that, there are some pretty strong seller controls and protections in place. We'll talk a little bit more about some of those. So here's a little schematic on how the Deferred Sales Trust works. So initially, it all starts with a client who's got an asset marked for sale. That client is going to work with their professional advisors, typically, such as their realtor or their business broker or their transactional attorney, to get that asset in shape, market it, find potential buyers, negotiate the terms of the ultimate sale with the ultimate buyer, and then this is what's going to happen as the process unfolds. So they've got their assets to sell. Before the close of the transaction is scheduled, whether it's escrow, before the close of escrow, the client will elect at that point whether they wish to sell that asset initially to a trustee, an independent trustee, which is obviously my role with the DST, in exchange for a secured installment note. Concurrent within that same transaction, the trustee will sell those assets to the cash buyer in exchange for the buyer's cash. This effectively keeps the proceeds at arm's length away from the seller, so that the seller is not in actual or constructive receipt of the proceeds, therefore is not required to pay taxes at that time. Only as the seller begins to receive payments or distributions from the trust do they have to recognize and pay taxes. So the trustee is receiving the cash, your ultimate buyer is receiving the asset, and then the trustee will work with the seller to create a seller-directed note, the terms of which are defined essentially by the seller with our help and guidance. They're going to pick the term that they want, and typically we're going to offer initially anywhere from a 1 to 10 year term. The seller will pick the term. They can always accelerate or extend that term at any time without any problem or consequence whatsoever, but that would be the initial term choices that they have. We're going to talk about the seller's distribution preferences. How much do they want to be receiving from the sales proceeds? And do they want it paid monthly, quarterly, annually? And what does that look like for the seller? And then we're going to come to an interest rate to be applied to the note. And the interest rate will be largely based on the risk tolerance for that seller. In other words, how comfortable are they, investing in things from the super conservative level all the way to the most aggressive type stuff, or like most of us, somewhere in between. It will be dependent on that. It will be dependent on how rapidly they want to be drawing from their sales proceeds, and what the ultimate term that they've selected initially for their note will give us the ability to come together on a reasonable rate of return to be incorporated into their DST note. So final part here, once that note's in place, the trust has the funds, we have a note in place, the funds are secured initially, so no malfeasance can occur. It's basically, there's significant financial support behind that, so nothing can happen to the client's funds. Clients will direct the investments, as we'll talk about in a second. But with the proceeds, the trustee will then make payments to the seller under that note that the seller has requested the terms from. So that's the schematic of how the DST works. So when we talk about, we just talked about the seller-directed note. that the seller actually controls the terms of the note. They control really the interest rate, the payments to be made to them, the term of the payments to be received, and they're also protected when things change. So for example, the note terms can be modified. The note can be accelerated, the note can be extended, the client can take cash at close, the client can access lump sums. It's just a function of documenting what the client wants to do. We can do everything except give them an ATM card, essentially, to just go in and just withdraw money. They still have to talk to me, the trustee. They have to let me know what they want to do, and if they need to change the payment structure up or down, something's come up and they want to accelerate and dissolve the trust and take all their funds, they can do that. They come to the end of a term, they want to extend it for another term of some sort, they can do that. Or in the middle, there's that need sometimes to access a lump sum because you didn't anticipate, some event happening. And people like to know, is it accessible if I need to? So as you can see, the DST is extremely flexible in terms of that, and the client has a lot of control. So they control the terms of the note, and those are some of the features. They also control the investment choices. So, before the sales proceeds can be invested in order to generate a return, as well as the ultimate return of all of the client's principal, the seller must approve investments used to secure their principal and rate of return. So this is just a list of some common investments that might be considered. The DST is always using an approved, vetted, independent investment advisor. And we literally have hundreds of investment advisors around the country that have gone through the process, both with our organization, the estate planning team, as well as their own broker-dealer or registered investment advisory compliance department, to be able to be approved to manage funds for DST trusts. And this would be a reflection of many of the types of investments that are available for consideration to make recommendations to the client, because the recommendations that the investment advisor working with the trustee and the client is going to come up with are designed and intended to meet the obligations on the note that the client has designed for us, which is how they want to get paid back. So the investment choices have to be correlated to those particular goals, and also make sure that anything that's in the recommended list is suitable for the client. So if I have a fairly conservative client here, nobody's going to come in and recommend cryptocurrency or C- bonds or junk bonds or something like that, because it just wouldn't be suitable or appropriate for a given client. So, but in addition to these types of investment choices, the client also has the option to reinvest into other. I guess I missed a slide, but they also have the ability to direct that investment proceed, or the sales proceeds, be directed back into other types of assets that really are outside of the scope of an investment advisor's purview, such as maybe they want to reinvest back into real estate. Maybe they want to buy or build a new business. Maybe they want to be able to manage hard money lending to other real estate owners. These are just some of the potential investment opportunities that are available. So I guess it's important to differentiate between a 1031 exchange here and a DST as it relates to selling your asset and moving into something else. Is while the 1031 exchange is limited to real estate as a replacement asset, the DST, once you sell your business or your property, you can have those funds reinvested in any bona fide investment class that's suitable for you, meets your needs, and is subject to your approval. So that's a huge value, I think, with the DST choice. So I like to talk about the three pillars of the Deferred Sales Trust. Sometimes I call them lanes. We drive in three lanes primarily, or we have three pillars. So the first pillar, or the first lane, is really the clients that looking for an exit strategy. And that exit strategy could be from investment real estate, could be from the sale of a primary residence, or it could be from the sale of a business. There are other types of assets that could be utilized with the DST structure as well, such as high value collectibles, such as art collections, et cetera. But these are the primary assets that we're typically working with as far as exit strategy goes, or just any part of this. And what it does is it allows highly appreciated investors to liquidate and reallocate for income while delaying capital gains taxes. A quick note on the tax benefits here, because I think it's important to note that there are two primary tax benefits that the DST offers. The first one is the ability to defer the taxes on your sale. By deferring the taxes on your sale, it allows you to use the money you otherwise would have paid in taxes to either generate additional income for yourself or to accumulate or grow your wealth more rapidly, because you're not diluting your proceeds with a chunk of taxes that are going out the door immediately. So that's number one. Number two is, we find that clients that are selling a highly appreciated asset as a pure exit strategy, they're generally going to be in the top tax brackets all around. So, capital gains tax brackets are anywhere, it's either 0, 15%, or 20%. State income taxes vary, obviously, from 0 state income tax from a number of states to an average of about 5 to 6 or 7% in a lot of states, to some of the higher tax states such as California, which tops out at about 13.3%. In addition to that, the third layer of tax that we all have to be aware of is the ACA tax, also known as the Obamacare tax, and that's a tax imposed on the sale of capital assets or excessive passive income that was installed in part to help fund the Obamacare or the ACA medical program. And so if you sell outright without any particular planning, you're going to find yourself in the top tax brackets all the way around. California, we look at that, you're likely going to be in the 37.1% tax bracket. You're almost at 40%. But if you're able to take your payments or take your profits and proceeds in installments, you can often, especially working with your professional tax advisor, tax engineer both your income or your distribution payments, but also the taxes that you will pay when you take distribution. So you may find yourself taking interest-only payments and not touching the principal and not paying any capital gains taxes or any depreciation recapture taxes, but you would pay ordinary income taxes on the interest if you're just doing an interest-only type of a distribution. But if you're also taking certain amounts of principal, then you might find yourself with the ability to reduce the capital gains tax bracket from 20 to 15, maybe 0, just depending on your other income. You may find yourself, if you live in a state like California that has a state income tax, that you can reduce the bracket or the percentage of tax that you would pay from the highest bracket to a mid-tier bracket, maybe from 13.8% down to 6.6 or 8% if you're a California resident. And then what about the Obamacare? Well, the Obamacare tax is sort of like the alternative minimum tax. It doesn't kick in at $1, it kicks in on a formula. And typically, just generally speaking, if you have $250,000 or more in passive income in a given year, sale of an asset like this would be part of that bucket, then that's when the Obamacare tax at 3.8% kicks in. But if you manage your total distributions at an amount less than that, or let's say, your total income is less than about $441,000 for, I think that's a married couple limit, your capital gains bracket's going to be 15%, not 20. So, you can sometimes save as much as 10 to 15% in the percentage of taxes that you pay when you decide to pay the taxes. So long-winded, focused on the exit strategy side here, but the second pillar of where the DST can come into play is using it as a 1031 exchange alternative. Bottom line is the DST can allow a seller of real estate that wants to reinvest back into real estate time to park their money and wait for the right deal. So the 1031, as many of you may know, has various timelines and restrictions associated with it in order to successfully defer the taxes on the gains of the property you sold. You must identify an upside replacement property, one or more, within 45 days of the sale of your asset. You have only 180 days in total in which to close the sale. You have to replace or better the value of the asset that you have sold, and you have to replace equal to or greater than the amount of debt that you relinquished when you sold the prior property. With the DST as an alternative vehicle, you don't have to meet any of those requirements. They are not part of Section 453. So if right now we're in the middle of the COVID pandemic, and there's obviously, it's upsetting, the economy, the markets, it's affecting business sales, even more than real estate sales. And, but for real estate, since we're talking about 1031 alternatives, for realtors or real estate investors, a lot of them are thinking that there's going to be a lot of decline in value for a while. There's going to be some great deals coming up, maybe in a few months, maybe in a year, who knows, but that seems to be a pretty strong sentiment, but in a 1031 exchange, you can't really take advantage of that because you only have 45 days to identify property that you'd like to purchase. So with the DST, you can effectively park your money for 6 months, 9 months, 2 years, and then redeploy back into real estate, finding the right opportunity instead of just whatever seems to be available, good, bad, or indifferent within the first 45 days. So that's where the 1031 alternative can come into place. The third pillar, or the third lane, is the DST serving as a rescue for a failed or failing 1031 exchange. So 1031 exchanges are interesting in that nationwide, about 20% of 1031 exchanges fail either partially or fully, meaning that the seller taxpayer is going to receive some level of boot or pay some level of taxes. It may fail just partially, and they may have some boot they have to pay tax on because they can't structure or find the right deal that just will allow them to defer everything. Or it may fail entirely because, what often happens, as a former real estate professional specializing in investment properties and exchanges, there was a lot of angst by sellers. They wanted to exchange when the time was right. But they were concerned knowing that the exchange might fail or they might not find a suitable property within 45 days. And oftentimes they're going to ask their agent what's available before they list their property. They're going to, if they find something that they like, they're going to try to see if they can tie it up before they put their property on the market. And that's just a nightmare, and that's a disaster because it gives you no leverage. And most sellers are not going to accept your offer with a large contingency being, oh, I have to list my property and sell it first, but then I'll buy it if that happens. And, they don't want to wait around for you. They're looking for other offers. And so with the DST, you can take that tax issue off the table. You can say, look, if you want to do a 1031 exchange and explore that, that's great. But here's a backup strategy for you if you want to use it as such. That won't cost you a dime unless you actually use it. But you can get legal representation. Trust can be established for you. We'll work with you and your transaction parties, and we'll have the ability to create a backup plan for you, or a plan B. So if you don't find exactly what you're looking for, or if you're down the path and your deal starts collapsing, you have a way out. And that's really the 1031 rescue pillar, is really a way out. And it's extremely effective, and it gives people peace of mind, and it takes a lot of burden off the the real estate agents who are trying to put the deals together in the first place. At the same time, they may consider the DST as the better vehicle, and in some cases it is, to purchase replacement investment property. So we can go into that at a different webinar as far as, when does the DST make more sense to repurchase upside property versus a 1031 exchange. But it's a kind of a fascinating subject line in and of itself. So move on to the next. All right. So one of the things that I think it's important for everybody to understand, because you may grasp this, you may think this sounds great, this sounds interesting, but who am I looking at? How do I know when somebody might benefit from using the DST and when they might not? So so here's a little piece about the minimum viable transaction that we would consider for the DST. That consists of any asset or a series of assets, because maybe you're selling more than one appreciated asset, which is marked for sale, which in a direct and tax transaction without any particular planning would subject the seller to taxes totaling $80,000 to $100,000 or more. So if you're selling without any particular planning and the resulting tax burden, federal, state, and Obamacare tax, would cost you $80,000 to $100,000 or more, then that's a viable DST transaction. Another way to look at this is to just look at what's the amount of taxable gain that I'm staring at. So the taxable gain I'm staring at for you realtors, it's cost plus improvements as your basis minus accumulated depreciation, offset against the net selling price of the property. That's your gain. That's what you're going to be taxed on. For a business broker or a business owner, oftentimes the basis is very low. There's very little invested in a business oftentimes if it's a startup, but then over time it becomes worth a lot of money. So, my experience has been that a lot of the businesses that we've been involved in assisting, about 90% of their sales price is capital gain or taxable gain of some sort. And so if the total amount of profit or gain that they're looking at is about $250,000 to $300,000 or more, then that also constitutes a viable transaction for the Deferred Sales Trust. So hopefully we got, because that's sort of important, identifying, the target audience for this, when it makes sense to bring it up and maybe discuss it at a more deeper level. Are you going to pay, does your tax person say you're going to pay $80,000, $100,000 or more if you just sell it? Or, if you're not sure about that, just like, well, how much profit or gain have you, experienced in this? If you sell it for X, how much profit have you made on it? And if that amount is $250,000 to $300,000 or more, then you might say, hey, here's something you might want to look at and consider. Quick summary of the DST benefits for the seller taxpayer is, number one, they get tax deferral. Tax deferral is extremely helpful and beneficial, as I described before. They can diversify their collateral, versus doing a direct, installment type of a sale. And that collateral is going to be seller determined and approved. Nobody is going to take their money and say, we're going to just put it here and invest it there. No, it's the seller is going to determine ultimately what's approved. We're here to help. We're a professional team that can provide advice and guidance and research and information to help them have enough information to make good decisions, guiding them along the way. But at the end of the day, the clients will make those decisions. And if those decisions need to be changed, the client's going to, approve and make those changes or instigate those changes. There's a ton of flexibility. We talked about how the payment structure can be modified, very easily and very often if necessary. We talked about the fact that there are very, very high seller taxpayer protections, protecting their funds. I'm not saying that funds that are invested are necessarily guaranteed, because it's fully dependent on, the seller's risk tolerance and what kinds of returns they're seeking and what types of investments might be deployed in order to achieve those returns. And those returns may carry some risk, but the funds from the sale directly, absolutely locked down and protected. There's no way the trustee could do anything. There's no way anybody could do anything without the seller's written approval and consent, as verified by somebody who's on the hook if that doesn't happen, a large $16 billion bank. And then, the final, summary benefit is the clients can often receive higher stable cash flow. I mean, when I've worked with, let's say real estate apartment owners or investment real estate owners that end up doing an exit strategy, let's say, once they sell and have, an approved investment portfolio for them that they want, most of the time, about 90% of the time, the net cash flow they're receiving is greater than when they still own the property. And they're usually blown away when they see that but it's true. Again, 90% of the time, transactions we've closed, that's been the result. So with that, I want to just give you a little bit of background on Campbell Law and the estate planning team, because Campbell Law and the estate planning team are the only authorized providers of the Deferred Sales Trust. As I said at the beginning, it's a proprietary strategy. Todd Campbell's the principal attorney of Campbell Law. He's also a CPA and an LLM in taxation. He perfected this over 2 decades ago. And the fact that we've gone through our paces, we've been through the fire, we've been reviewed by the IRS, other prominent national tax and CPA firms, FINRA, a ton of people have actually looked at this and evaluated it independently. Any other practitioner that can sort of figure out some of the details of actually consummating transactions and keeping them viable and safe for the duration, I'm not saying there's not smart folks out there that can't figure this out. There is. But what they can't do at this point in time is demonstrate the same type of track record, the same type of scrutiny, the same type of reporting. For example, with 3,000 plus closed transactions, there's been probably tens of thousands of tax returns filed and accepted without any negative finding over 2 decades. So when a client is putting their trust in a tax strategy that may be new to them, even though it's not new, they're going to want to know that there's a track record that they can rely on that's going to protect them and give them the desired result. So with that being said, who's the estate planning? So Campbell Law, architects of the Deferred Sales Trust strategy, tax attorneys, CPAs, they're the ones that structure every single transaction. They are always the law firm that's involved in putting together a DST. And then the estate planning team is really an association of lawyers, trustees, financial services professionals, all committed to helping preserve clients' wealth and protecting their estates. The estate planning team as an organization provides sort of the national foundation footprint in support of promoting the Deferred Sales Trust. So they also provide training, marketing, administrative support, technical support, oversight, vetting of professionals. They provide a pretty large role to make sure that the track record that we've enjoyed over 2 decades is going to continue, because we're all working towards the same goals. We're all observing the same code of ethics, and we're all agreeing to allow other people to participate, to look over our shoulder, so to speak. So, we're always, an open book in terms of that with the clients, with other folks. So let me just see anyone I want to show. So that's who the estate planning team. And if you're a professional in the area of real estate, business brokerage, tax, personal attorney, you actually have the opportunity to join the association, if you will, the estate planning team, if you're interested in being able to offer the strategy to your own set of clients, and and maybe be able to participate financially in putting cases together, then you're welcome to talk to me about what's involved. It's not that tough, it's not that detailed, but on access to maybe some help with marketing, some additional training. I do these webinars every month. I put out a newsletter every month to try to provide more education out there and some training. But there's lots of other things that we can do to help people evaluate potential transactions for clients before we even bring it to a client. You might want to have it pre-analyzed. All you need to do is gather a little bit of data, not much, and we can kind of determine if it's suitable or appropriate and maybe take it to the next level. Myself and other folks can help you have conversations with clients if you want. But again, the biggest part of today's webinar is really, we want to try to build more bridges with tax professionals and independent attorneys that represent your clients. Because the fact of the matter is, a lot of them haven't heard about the DST. They actually probably know more than they think they know, because they're going to be familiar with Section 453. They're going to be familiar with installment sales, but they're going to have, if they haven't heard of this before, they're going to have a mindset about how a traditional installment sale works, and they're going to have in their mind about the defects or the downsides that affect the sellers. But once they learn that there's a strategy that actually takes the bad pieces away and returns all the control back to the seller, then it's something that should be something they can dig a little bit deeper into, to where they fully understand it and can make good recommendations to the client where it fits. I'm not saying it fits in every single situation, but there you have it. So this screen is my individual personal contact information. If you have any questions, I can unmute everybody here, and if we've got any questions now, but let's see if we can get that done. Unmute all. Okay, so do I have any questions at this point from anybody?
Is this an irrevocable trust?
The trust is actually a revocable trust, but it's really the cornerstone of the trust that we typically use is a Missouri business trust, which is a hybrid between a corporation and a trust. It allows us to elect different tax structures, depending on what's the most suitable for a given transaction. It's not like a traditional trust that it carries beneficiaries to it. So a business trust it operates more like a corporation in practice than does like a living trust. But the clients have a secured interest in it. Their role in the trust is that of a secured creditor, much the same as a bank would be the secured creditor when it loans money to you against your commercial building. So, that has a lot of legal teeth in it for them. That's what gives them control over the collateral. That's what gives them control over the terms of the note. And all of the trust assets are owed to the client. Another word about this, or a piece about this, is clients' money in a DST has a tremendous amount of asset protection in it as well. Because if a client is sued and they get a judgment against them for some reason, their creditors are highly unlikely, almost impossible. You have to say almost impossible. That creditor could get access to the client's principal that's in the DST, because it's structured based on a note, and the note has an obligation to pay the client, whatever stream of distribution they want, but the underlying principal is going to be off limits to their creditors, because as trustee, I'm not cooperating with their creditors. I'll tell you that right now. And I'm not legally obligated to cooperate with them, other than maybe they could step in front of an interest dividend distribution that the client's set to receive if it came to that. So that's a pretty powerful piece of this too. Next.
Yeah.
Hey, Greg, can you just go back to the item about a rescue for 1031? How many days or weeks do you need prior to the close of the 1031 45 days to set this up?
Okay, great question, Mac. Thank you for that. So in order to do our work successfully, we have to create the structure in advance of either the close or the next tax triggered date. So typically we're going to need 10 days to 2 weeks, sort of at the low end. We love to have more time if we can have it, but we can operate pretty effectively if we have 10 days to 2 weeks before either the close or the tax trigger date. So what are those dates? The first date would be the close of escrow. What is the scheduled close of the transaction? That would be your first that would be your first trigger date. So we want to be engaged with the client at least, let's say, a couple weeks in advance of that date in order to weave the DST into the actual sales transaction. If you're a real estate investor and your funds have now gone into a QI, qualified intermediary, 1031 exchange accommodator, then you could bail out into the DST on day 46. So we would want to, if your money's already with an accommodator, then we would like to be engaged, involved, and working with you 2 weeks ahead of that 45th day, okay? Because if you need to or want to, you may want to bail out of the exchange into the DST, have that money go to work for you a lot quicker and do it that way. The final tax trigger date is the 180th day of an exchange. At that point, if the accommodator is holding on to any of your money, they have to give it, typically, they have to give it back to you and send a 1099, and notify the government so you can pay your taxes as quickly as possible. So if you're already past the 45-day threshold, you've identified property, but then in the intervening, the remainder of the 180 days, the thing's blowing up, we're going to collapse, we need to be involved a couple weeks before the 180th day, because it's on day 181 that you'll be able to successfully exit into the DST. One caveat, there is one exchange accommodator that we know for certain will not cooperate with the seller. That accommodator is the 800-pound gorilla in the industry, and they are IPX. IPX created a poison pill in their contract after they got sued by a client whose exchange failed, and they were just waiting for the 180 days, so they're going to have to pay their taxes. And they learned about the DST. They were desperate to not pay the taxes. And so IPX said, no, we're not going to cooperate. And so the client sued them. IPX agreed at that point to transfer the exchange to a different accommodator. And right after that, they changed their client agreement to prohibit, to make it impossible for them to cooperate. The reason being, they make most of their money on interest on the money, your money that they're holding. And they didn't like the idea of people leaving on day 46 so they wouldn't continue to make money. So they actually put a poison pill provision in their contract. They're the only accommodator in the country I've come across so far that will not cooperate. But I feel like I have to say that because, you could have a client that comes to us. I just had a call yesterday. Client already sold his property. His money's with an accommodator. He had one property identified. He's like, 50 days into the thing, and he goes, I can't buy this property. There's way too much wrong with it, and I have no place else to go. He goes, can I do it? And I would just say, who's your accommodator? And he said, IPX. I just said, I'm sorry. You can ask them, but they're going to say no. And they're going to hold on to your money for 180 days, and then they're going to give it back to you, and you're going to pay your taxes. So if you have somebody that's already in an exchange, and that's why I bring this up now, is like, yeah, we could still get involved. We could still help them as long as it's not IPX.
So technically it's a 2-point rescue. Technically it could be a 2-point rescue.
Well, there's two points in the timeline. So the 40 day 46 and day 181. But as far as our involvement, try to come to us at least 2 weeks in advance of that trigger point.
Yeah.
Okay. Thank you, Mac.
Thank you.
All right. Anybody else got any initial questions or thoughts?
So one question I would raise is how many are doing a DST with high value residential?
High value residential is, if you're asking a percentage between like businesses versus investment property and a high value residential, I would say high value residential is probably only 10%, of the business we do. And I think part of that is, this concept is appealing to business brokers and to commercial real estate professionals because they're dealing in more of the business space, right? Residential realtors are not as inclined to gravitate towards this, so they can bring this forward to their clients. If they work in the high-end residential marketplace, and they can get exposed to some information. You're more likely to, but that's probably why, a little bit lower percentages go in that direction. Thanks again, Mac. All right, so anybody else has anything, feel free to chime up, but contact information is right there. If you want to email me, call, have a particular client that you want to talk about, wonder what else is involved, have any additional questions that may be just more specific to a given transaction, feel free to do that. We will be republishing a video basically on this presentation on our website, and you'll get an email. So if you ever want to go back and view it or view any of the other, library pieces that we have, feel free to do that. But, I appreciate everybody taking the time today. I know we took a little bit longer than usual, almost an hour. So for those of you that stayed with us, I appreciate it very much. And, let us know if there's any way we can help you.